If you're thinking about buying a home or you're in process, talk to Pete or somebody that really understands credit, because paying off your credit cards is not necessarily the answer.
Wayne, how you doing?
Great.
All right. So this is our third or fourth time we've been doing this now, and it's great because we stay really connected with what's happening locally in our local real estate market and what's happening in our community.
Right.
And you always bring a really good amount of numbers and statistics, and
Absolutely.
really good to understand what's happening.
Yeah. I'm Wayne Martin of Real Estate One. Been in the business for most of my life and practiced real estate here in Redding, California, the greater Redding area, for about 20 years. So we do monthly statistics to keep up on the market.
Yeah.
So
Yeah.
let's get going on
Yeah.
that so people really know what's going on. Why don't we talk about market statistics year to date? That's always kind of an interesting indicator. Year to date closing, and this goes up to the end of July, was 1,381 units, which is 16% down from last year.
That's the number of transactions.
The number of transactions. The average sales price went up approximately 2.2% over last year, which is kind of amazing. The other thing that's happening now is we're accumulating more listings. So listings are up 5% over last year. That's good for the buyers.
Yeah.
It's
that's
still
really good.
tight. It's not necessarily a seller's market, but it's not necessarily a buyer's market. There's kind of equilibrium in the marketplace
Right now.
right now. The other thing too, if you're watching this and you would like to get a copy of what we're talking about, we mail these out monthly. And it's a total report on what's going on. It's very in-depth. If you don't quite understand it, you can always give us a call and we'll work you through it.
Yeah, if you're thinking about selling
Or buying, you need to know these numbers.
Yeah, you definitely want to know.
You want to know what's going on. We break it down per $50,000 increments. So if you're looking to buy, say, 200, we have all the stats from 200 to 250, 300 to 350 on all that. So it really helps you break down what's going on in the marketplace.
Yeah, what's interesting is that the number of transactions went down. So I was going to ask if you explain that to us. What's also interesting is inventory going up. So maybe it's correlated. I don't know.
Well, it's based upon the number of closed transactions. So we're down roughly 15%, 16%.
Yeah.
So there's less sales, basically,
Yeah,
is what
less
it amounts
sales.
to.
And it doesn't mean that real estate is going down. It just means
no,
there's
not at all.
Less amount of money exchanging.
Right, exactly.
Yeah.
But part of that problem has been we had interest rates that moved up. There was a lot of sticker shock. People got used to that 3-4% interest rate, and it actually went back to more of a normal interest rate, even though people don't want to hear this. 7%, 6.5%, that's normal.
Yeah.
Yeah, when you take a look at a 50-year chart of interest rates, the actual average was 8%. When you go way, way back, that's the average of it. And so
rates-
really, even truly, up until 2000, the average rate was
8 or 9%.
Yeah,
maybe
it was 8 or
10%.
9%.
Yeah.
Yeah. A lot of money came into the market,
Yeah.
and rates went down. And then, of course, our lovely politicians in Wall Street screwed the economy up so bad they had to drop rates to 3%.
Yep.
Artificially. Government had to buy back. It was a nightmare. So the idea, at least from my point of view, and maybe you can corroborate this, we don't want to see 3%. I mean, as a buyer, you want to see that. But we're probably not going to see that, hopefully.
Yeah, I agree. If we see another 3%, that would mean that the government has to step in again for some kind of pandemic or some kind of some problem. So we definitely don't want that to happen.
No, we do not.
Yeah, so we want normalcy.
Right.
We want standard market to do its thing.
But this is what's interesting to me is affordability. We had this conversation not too long ago. Shasta County affordability is better than it was. Here we are in 2024. but in what was the year? 2004?
It's like 2004, 2005, somewhere in there. Yeah, I'd have to look at the chart again. But
Yeah.
yes, it was worse.
It was worse. Affordability
now.
was worse in
Yeah.
this area than it is
Yeah.
today.
Yeah, and
which
that's
is kind
based
of
on-
interesting to me.
And how they measure the affordability is based on average income
Right,
and then average sales price.
right.
So that's how they gauge the affordability.
Right.
And so back then, the average income was a lot less
Was-
than where we're at now.
Oh, yeah.
And obviously, the average
Right.
sales price, the relationship between the two was worse than it is today.
Right. But there's the other thing that's really kind of neat. There's some new loan programs that we're going to talk about
Yeah.
once we get through some of these numbers
Yeah.
that you'll be very interested in if, you're.
Yeah, you definitely want to wait around
Yeah, to
in
the
a couple
end.
minutes because we're going to talk about some really cool.
Right.
Yeah.
Right. One of the things that I'm seeing on my side as a real estate broker representing a lot of sellers, a lot of buyers, is we're seeing a lot of cash buyers or a lot of large down payments because a lot of the seniors are selling or third tier buyers are selling and they're coming out with cash and they're relocating. A lot of times they're relocating from outside the area or they're in areas with high fire insurance policies and they're moving to town
Yep.
because they're looking to retire, or a lot of times they're medical issues and they're outlining areas and they're moving to Reading.
It'd be closer to hospital, closer to medical care,
Exactly.
dental care.
Exactly.
Yeah.
The other thing that's happening in Reading, which is kind of interesting to me, is there seems to be a certain level of turnover in management of medical, of other industries that are here. And so we're seeing people move in and out of Reading that are at management level. They're usually second or third tier buyers.
Oh,
so
interesting.
we're seeing movement in there of
So-
relocation.
So doctors or maybe nurses, different medical managers,
yeah, medical managers of other industries. There's-
relocating outside.
Yeah, they're
relocating
leaving the
Got
area.
it.
They're just in different service
Yeah.
businesses here in Reading, and
Reading-
they're relocating.
And we have a
And
pretty
vice
good,
versa.
Yeah, we have a pretty good medical economy here. I
Right.
mean, we have
A lot of
two,
people are
two big
employed.
two big hospitals.
Yes.
And expanding, yeah, because we have a new hospital coming in for Wind River.
Wind River's building a hospital.
Yeah.
That's what we're told. And then Dignity Health seems to be, they have a new campus they're going to be building out
Wow.
at some point.
Yeah.
Down off Hartnell and Cypress down in that area. It's very intriguing. And then the other thing, the industrial park is working to be built out and creating new jobs that are manufacturing that are higher paying. So there's more and more pressure coming into the greater Reading area.
More money coming in.
Yes.
More
And
business.
more business and higher paying
jobs.
higher paying
which is
jobs.
very,
very important,
very good if you are a homeowner,
right?
but also an opportunity if you're a renter,
Yes,
because long term, if you're buying,
right.
it's good.
Well, for instance, just in my neighborhood, we live in Paris Park.
Mm-hmm.
It's a little seniors community. Let's see, 6 years ago we bought for $250, and we thought we'd probably be paying over a little bit. It's 1,450 square feet.
What year did you buy?
6 years ago.
6 years. Wow. 6 years
So
ago.
a home just sold for $400,000 in our neighborhood.
Wow.
Yeah. So that's the power of appreciation, and
Yeah.
it's
Yeah.
kind of incredible. So home prices are moving up, interest rates tick down, and employment continues to grow in this area, and there's not a lot of building on. Appreciation is going to continue. Nobody has a crystal ball, but it's a pretty safe bet that appreciation is going to continue. So
Yeah, I think the only way it wouldn't is if all of a sudden we had a lot of homeowners decide to rent.
not going to happen. Because everybody that has those 3% loans, trying to pry them out of a house to make them have them sell, it's just not happening.
And decide to rent.
Yeah, we list a number of properties, and what we're seeing is people are relocating next to family. A lot of our clients tend to be baby boomers or traditionalists. Basically, somebody that's going to be over 60. A lot of those people are selling, which leaves room for younger people or other people to, buy their homes. But
Yeah.
we have people moving to Tennessee, Kentucky,
Yeah.
Texas,
Yeah.
Idaho, you name it. And then we have people that have moved there that are coming back. It's really, it's kind of a transitory market. It's pretty
Yeah.
wild.
I think this is an amazing area in Northern California. It's an
Absolutely.
incredible place to live. It gets a little hot, but gosh, I mean, we have some amazing schools.
Right.
We have an amazing community.
Yes.
It's not, the traffic isn't bad.
People are friendly. The
Yeah.
biggest traffic jam is just up the street on Cypress
Yeah,
and
exactly.
I-5.
Yeah.
Hilltop.
Just don't hit it at 5 o'clock.
Well, even that, I had to wait,
5
3
minutes.
minutes,
Yeah,
5
3
minets.
minutes,
I'm
yeah.
really angry.
Yeah.
It's so funny when we have people that we show property to here that are coming from the Bay Area, LA, or even Sacramento. They go, "What? There's no lines. I can go to the movies.
Yeah.
There's no big line.
Yeah.
I don't get it. What's going on?"
Yeah.
It's like, this is Northern California.
Don't tell your friends.
Yeah, tell your friends. I'll help them out.
Yeah. Exactly. Yeah.
Exactly.
Yeah.
It's Redding is the best untold secret,
Absolutely.
right?
Yeah.
I mean, we live here. It is fantastic. Yeah, I'm glad it's hot. I grew up here off and on as a kid. We moved around. My parents were in construction, and so we moved back and forth depending upon what's going on with the economy. But it's always been fantastic.
And our airport is getting bigger.
Yes, that's growing.
Airport is
Definitely.
getting more busy, and more airlines are wanting to come in, I think.
They're working on expanding, getting another terminal.
We have
from
United,
what
I think.
understand.
We have United. We have Alaska Airlines.
Yeah.
United goes to San Fran, to Los Angeles. And then we have another, what's the other one that's going to Vegas? Is that still around?
No, they don't go to Vegas,
Vegas.
but I believe they're still around.
Oh, yeah. They go to.
You're a big
Burbank.
traveler and flyer, huh?
Anyways, we have
Unlike me.
the airport is
Yeah.
getting better.
Yeah.
So you can fly places.
Yeah, absolutely, absolutely. But can you imagine if we had good weather all the time, not hot weather like we have?
Oh,
There'd be 1 million people here.
there would be. Yeah.
Yeah, that
Yeah.
would suck.
Yeah. Yeah.
This is we
Yeah,
like
so
the
it's-
rate of
yeah.
growth that we have, right?
Absolutely.
It's a wonderful thing.
So
let's get
July,
back on
July
track.
looks like it's picking up.
Yeah, July is picking up. We had 241 transactions closed. That's 8% up from the previous
year-
month.
From the
no.
previous month. Yeah.
The previous month.
Yep.
And so we have 2.6% a month of inventory. So normally that would be totally a seller's market, but that doesn't.
Depends on the price range, probably.
Depends on the price range, and there's less buyers in the market, to be honest. So less sellers,
Less buyers.
less buyers.
Yeah.
So it's really what we're seeing is there's a lot of equilibrium in the marketplace, but that's, I believe, going to be temporary.
I agree.
I think that it's going to become more of a seller's market.
I believe that as well, but explain why you think that.
Well, I think as we get past the elections, there's more stability. People are working on paying down their credit, improving
Yeah.
their credit scores, right?
Yeah.
Very
Yep.
important.
Absolutely.
On qualifying, especially when you're at a higher rate like this, you got to get
Yeah.
your debt ratios
Yeah.
in order.
Yeah.
By getting your credit score up, which I would recommend if you're thinking about buying a home or you're in process, talk to Pete or somebody that really understands credit, because paying off your credit cards is not necessarily the answer.
Correct.
There is an extreme amount of strategy around building credit, which can save you thousands of dollars, right?
Oh, absolutely. I mean,
Yeah.
a lot of people think, I think we talked about this last time, but a lot of
Yeah.
people think that improving your credit score, you'll get a better interest rate, which is true. But also what they
Right.
don't talk about is you'll get a better rate on your mortgage insurance.
Which is very important.
Very important. I mean, your mortgage insurance could be hundreds of dollars more expensive depending on your credit score.
Correct.
So, like, if you have a 740 credit score, you're buying for, let's say, $350,000. You're putting, let's say, your first-time buyer 3 to 5% down, or you're doing 100% financing. That mortgage insurance will be like 0.3%.
Okay, what does that
Ish.
translate to?
Dollars.
and cents.
Dollars is like $70, $80, something
Okay.
around there. And then if your credit score is, let's say, 640, you're talking like $300.
Oh my God.
month.
A month.
Yeah, difference. So like it can
Wow.
be a big difference on your credit score.
So you're talking over $200 just in the difference.
And this is on a conventional loan, and this is why you want a good professional mortgage person to help you, because you have the FHA. FHA mortgage insurance is the same no matter what.
Okay.
But mortgage insurance for FHA for that same was going to be like $180 to $200 a month.
Okay.
So it's still more, right?
Right.
But also you have to pay the upfront fee for FHA.
Oh,
They charge
okay.
1.75 upfront in addition to the monthly, whereas conventional they don't have
Right.
to do that. So
Right.
it's literally thousands of dollars based on that credit score.
So I can't stress enough how important it is if you're thinking about buying, talk to Pete.
And we have technology. We can do a soft pull, number one. We don't have to do a hard inquiry.
Now explain what that is and why
Yeah.
that's important.
Yeah. So a soft credit pull is we get the same data, same credit score, all the same information, but it doesn't actually put an inquiry on your credit. So a lot of people are concerned on getting a credit ran or an
Right.
inquiry on their credit because that does affect your score as well. Well, a soft pull, it doesn't actually show up. It's not an inquiry. It allows us to take a picture of your credit so that we can help you.
Oh, that's
And
fantastic.
yeah, and so it doesn't affect. And so really, it's like an amazing service that you can have a professional review this for you.
Right.
Take a look at it, and then if you're going to buy in a year, let's do that. Let's do
absolutely.
a soft credit pull. Let's check it out.
And I think that that's very important. I've been doing real estate pretty much all my life since I got
Yeah.
out of high school, basically. Builder, developer, had my own mortgage company
Yeah.
for 12 years, realtor for
Yeah.
God knows how long. Anyway, but I had a client come to me and his credit was atrocious. And we were able to, get him with a great lender and really work it out what that person needed to do. And it took him 6 months to a year. I'm thinking about 8 months or so.
Yeah.
To really clean it up. He really applied himself at work and got a raise and all this other stuff, but he really cleaned up his credit and he bought his first house. A couple years later, he bought his second one. A couple years later, he bought his third. So
Life-changing.
Life-changing. And you go, oh, I can't, what am I going to do? I mean, he's like, he had that desire, was willing to work on it and take direction from an expert. And that really, got him going, right?
Yep, absolutely.
I mean, you see that all the
100%.
time.
Oh, yeah. Oh, yeah.
So if you have poor credit, Pete can walk you through it.
Yeah. The number one thing I would say with credit is just see if you can set up your payments on auto pay.
Right.
Like get those
Don't
payments
miss
set up.
them.
Yeah, don't miss. A 30-day late can affect your score more than sometimes a bankruptcy. I know that's a little bit seems
Right.
outrageous, but when you're looking at a score, you don't want to do bankruptcy, number one. A 30-day late is really bad on
Right.
your credit. So you could have perfect credit, 750 credit score. You go 30 days late on one account, that could be over 100 points on your credit.
Oh my gosh.
It's happened to me where I have it set up on auto pay. I forget about it. Life gets busy for me. And all of a sudden, boom, I get it just 30-day late. I'm like, oh my gosh. Sometimes you can get it reversed, but a lot of times you can't. And I was not able to get it reversed. And
Wow.
so it
So you had
affected.
to work your way out of a
I
hole.
worked my way out of the hole. Eventually, after 5 or 6 years, I was able to get it deleted. It was a short little climb. But my biggest recommendation is set up everything on auto pay. The minimum payment.
Right.
Of course, you can pay extra as you need.
Sure.
But just 101 auto pay.
Yeah. What would be the next thing with credit cards? 50% balance. Don't go over that.
Yeah, you don't use your credit cards. I mean, obviously the credit cards are there for emergencies. So of course,
Right.
if you lose your job or something like that, that's what they're there for. But
Right.
the credit card is there to help you establish some credit. I would only use it to establish your credit.
Right.
Keep that balance under 30 and always have enough cash to pay it off.
Right. That's very important.
Yeah.
'Cause-
Basics. I mean, I know
Yeah,
it's
it's
hard.
just basic stuff. I use a
hard.
credit card. I don't use an ATM card. I use my credit card, but I pay it off every month.
Yes.
And I never go over 50% of the balance, which, I
there's
have
other
available,
benefits. Yeah.
not balances, but available cash.
credit. Yes.
But it's just microscopic compared to, what I can
that's a
use.
little bit more an advanced strategy because eventually what happens is with your credit, you can start getting miles, you can start getting extra additional things.
Right.
Not to mention, have you ever seen that movie Catch Me If You Can?
Yeah.
With Leonardo DiCaprio.
Yeah.
Okay, so that guy, I forget his name, so I watched him speak in front of Google campus. And he said the number one thing you want to do is not ever use your debit card because
Right.
that's the biggest risk you have for identity theft. A credit card, if someone steals your credit card,
Yes.
then the credit company a lot easier can replace that money quicker. An ATM, it's weeks and weeks and weeks before they
And you have
replace
to
that money.
catch it. Don't you have to catch it within like 72 hours or something?
yes, yeah. And
There's a time
yeah.
frame. Otherwise, it's just you can't do anything about
So
it.
that's more of an advanced strategy where you have enough money to pay it off every month,
Right.
and then you're building miles or you're getting credits
Right.
back and stuff like that.
Right. But it's an important thing to understand and have control over.
Yeah.
Because you can really make it work for you. Because there's a difference between good debt and bad debt. Bad debt is the debt that doesn't make you money.
Right.
Right?
Right. Exactly.
It
Cost you
isn't
money.
building it isn't building cash flow, or it's not building an asset value, or hedging inflation or
Yeah.
creating a write-off.
Yeah.
That is good. The debt that
Correct.
does that is good debt.
Right.
And that's buying a home can be good debt as long as you have a good strategy, you're stable,
Yeah.
you know what you're doing.
That's good.
Yeah, we went down the rabbit hole on that, but I think that's important for the audience to hear.
I think that's very important. Yeah.
Let me ask you a question, since we're talking a little bit financing, and because home prices are higher, explain how gifting works for a down payment. I think that's important, because a lot of parents will help, or siblings
Absolutely.
might help, or aunts and
Absolutely.
uncles.
Yeah.
How does that work?
So a lot of first-time buyers, a lot of people think that they have to come up with this down payment or come
I hear
up with
20% all the time.
Yeah, it's not true. You don't have to come up with 20%. You can
No.
you can buy a house with as little as zero money down.
Correct.
And you can also get a gift from relative or family to help you with that down payment. Now, you don't have to do that, but sometimes first-time buyers, they have family that are willing to help. And if that's the case, then you can get a gift of any amount gifted to you from a relative, someone that is
Right.
related, then qualifies to purchase to a conventional FHA. You can use it for any of those loans. A lot of people don't know that you can get a gift
Right.
from family members. Now, the one thing, with the gifting is, as the giftor maybe talks to a tax person, because
Right.
they can be taxed based on how much you get a certain amount every year
Right.
that they can gift to each child.
Right. So that can be a strategy to help get you in a home,
Yeah.
or as far as a down payment's concerned, might help you with closing costs.
Yeah,
or
like
both,
I
right?
I have customers come to me and say, Pete, I have up to 20,000 of a gift that I can get from
Right.
parents, and I show them, okay, here's an option if you did 100% financing. Here's an option with that 20% that you want to use to put down, and often they'll take the 100% and use that $20,000 as reserve.
Right.
And the reason why is because that payment difference isn't a great
That
deal.
much
It's
is
like
a great deal.
$120 ish
Right.
for a $20,000 difference.
Well, the other thing too that I think is important is when Freddie and I are working with buyers, we're taking people through homes, we're assessing the appliances, we're assessing the roof, we're looking
Yeah.
at decks, we're looking at all these different things that may come back and need to be fixed, either for the loan to close, or a couple years down the road. Is the buyer going to have money to
It's so
make
important.
repairs?
It's so important to have someone in your corner for that. as a
Yeah,
realtor.
because the thing that I see, and don't mean to throw a lot of shade, but a lot of times when you're with an inexperienced agent, they're doing their best, but they don't know.
They don't know what they don't know.
Yeah, exactly. But sadly, you're the one that's paying for what they don't know. And it can come back around and bite you. So it's just really important to work with somebody that is seasoned, is experienced. They're working in your best interest, and they're not just trying to make a deal. We're trying to make the best deal possible for you, but we're looking at it over a time frame too, because there's ramifications. Like a roof could be 20 grand. Well, maybe this roof only has 3 years, 4 or 5 years. What is your game plan for that?
Yeah.
Now, maybe only half the roof has to be done.
Yeah.
Or, maybe you have family or friends, or maybe you're going to learn how to put roofing on.
Yeah.
But, there's things that we have to
least-
look
at
at
least-
and at least talk about
Talk about and know
and know.
before you move into that decision.
Right.
You don't
And
want to
then-
go in blind.
Right. And then it might make sense that, a lot of people always want a deal off the sales price. Well, maybe the strategy is we give them full price, but we're asking for concessions. And it could be that the concession is they pay your closing costs or a portion of it. Nowadays, it may be that you keep your money that you were going to spend on closing costs because you're going to have to do something on that house, or you want to do something on that
Yeah.
house. And so you look to get seller concessions.
Yep.
And that,
Yeah.
but you got to know what you're doing.
Yeah.
And you got to have a game plan.
Yeah. What is a seller concession exactly?
Seller concession would be where this seller, say the house is for sale at $400,000, and your average closing costs on something like that. I see a lot of people ask for 3%
Yeah.
on $400,000. I don't believe
$12,000.
you don't need $12,000 to close it, but you may want some extra money to make repairs once you move in.
Yeah.
And so that would be a concession where they
So
say,
concession is like money the seller takes from the proceeds of the sale to then
Correct.
give back to the buyer to maybe for a repair or
Right.
to cover some costs.
cover
that
some
the
costs.
buyer
Maybe
has.
maybe the carpet's totally trashed. It's old, whatever, but they're not going to replace the carpet before you move in, so
Yeah.
they make a concession. There's
Yeah.
different ways to go about it, where if you have a little bit of cash, you don't spend your cash, they spend theirs first.
That's an amazing strategy for buyers to be able to utilize that maybe they didn't know they could do
Correct. There's a lot of different strategies for the buyer to work with the seller. What we want to do is put the buyer and the seller together so both their needs are met.
Yeah.
And it isn't always about sales price. It's always about what the seller walks away with, because they need that money, but they also need to sell it and
that. Move on.
and get somebody in and take care of any problems, because what I'm seeing in the marketplace today is a number of the houses need work and the sellers are not doing the work. And so that's going to be transferred over to the buyers. So we really want to take a look at how to structure the deal so that it works for the buyer. There's a big desire for the buyer to buy that house, even though the work needs to be done in the future.
Yeah.
Some of it depends on the length of time, that something may be done. It's like conventional tends to be a little bit looser on fix and repair
Correct,
than FHA or VA
Correct. Yeah.
type loans.
Yeah.
Right. If it's health and safety issues, then they have to be done if
Before the
appraiser,
loan.
Yeah, before the loan closes.
Yeah.
So if you have any questions about that, you can always reach out to us. There'll be information somewhere, and we'll be happy to help you.
Yeah.
So do you want to talk about this amazing new loan program?
Yeah.
It's only been out a little bit.
Yeah, it's only been out a little bit, and talking about affordability, it's been very challenging for a lot of first-time buyers to purchase in this market. So this program, quite honestly, is the best program, and I thought I'd never say this because the Dream for All program I thought was really, really good. Well, this actually beats the Dream for All like crazy. So hear me out. If you are a first-time home buyer and you are in the market, or if you don't own a house, you don't have to be a first-time home buyer for this program.
Correct.
You just cannot own a current home right now, or
Right.
land, or can't own any property at all. But you could have owned a year ago and still qualify for this program. So this is what the program is. So they call it Recover California. You can look it up online. We could help you with this as well. We can help you get qualified. We can help you with the program, show you what this be for you. But you get up to, pause for this, $350,000 for a down payment.
Yeah, it's incredible.
So all of you,
and it even gets better.
I know.
And there's more.
It can be forgiven
In 5 years.
in 5 years. Yes.
So say you got that $350,000, and in
is
5
life-changing.
years it was forgiven.
You have $350,000.
You know what that's equivalent to? I was running the math in my head. You would have to make over $500,000, pay taxes on it,
Wow.
to end up with
$350,000
$350,000
in 5 years.
in 5 years.
Yeah.
But okay, let's get into the weeds a little bit about
Yeah.
how you qualify for this.
Okay, so down payment assistance, you have to have credit score, 640 minimum credit score or higher. You can do
Right.
conventional FHA, VA. You can do all those types of loans with it. Single family residences, townhomes, condominiums, and manufactured homes. You can
On
do
property.
on property. It has to be on a permanent foundation.
Right.
Of course, I said you can't own a home currently. The big qualification thing is you have to have lived. It's called Recover California because they're helping with people that were affected by the fires. And so if you lived in 2018,
2018,
yeah.
Yeah.
If you're affected by the fire, this program is saying by affected, if you were in a fire zone.
If you're in a high fire zone.
High fire zone, then and you don't have to have owned a home during then. You just have to show that you lived in a high fire zone at that time. The other caveat is you have to buy in an area that's not a fire zone.
It's in a low fire zone.
Low fire zone.
So basically, City of Redding,
City of Reading.
You know,
yeah.
there's a map that the lenders
Yeah.
look at to make sure that that home that
Yeah.
you're going after qualifies.
But think about this, Wayne. I mean, the other thing is you're in a low fire zone. Your insurance can be cheaper too.
Absolutely.
Right? Your homeowner's insurance.
By far.
Yeah.
I've seen fire insurance policies out in the country. We've run into this a number of times.
Mm-hmm.
They're between $15,000 and $7,500 a year.
That's insane.
It's like, yeah.
So I unfortunately don't qualify for this program because I currently
Neither do
own a
I,
house.
sadly.
Yeah. However, if you are listening and you qualify for all of those points that we just talked, give Wayne, give myself a call. We will help you
Absolutely.
get into a home.
We're all over this
Yeah.
program because it's really a great way for someone to get started.
Yeah.
I mean, oh my gosh.
Yeah, it's like the lottery. So
It is.
there is a limit on the funds. So we called just a little
Right.
bit ago.
Yep.
And today's August 27th. They're halfway through
the money.
Through the money. Yeah. So they got to
Right.
get
So
Yeah.
you need to make an application right away. It's the same type of underwriting as
Yep.
like
Yeah,
if you're
just-
getting an FHA
you just,
or
yeah,
VA
you just
or
got to
whatever.
call us. We'll get you
Yeah.
qualified. We'll
Yeah.
walk you through it.
You could do it over the computer or talk to Pete.
Correct. Yeah.
You don't necessarily have to come in.
Yeah.
If you're busy. The other thing too is maybe this is not right for you, but if you know other people that are,
Yeah.
you really want to say, hey, call Pete. Call, just get on it right now.
Yep, yeah.
I mean, it's
Yeah,
not
if-
free money,
If you're
but
listening
it's
to this,
darn close.
Yeah, if you're listening to this, if you know someone, give them a call, give them our number. We'll call them for you. We'll get them going.
Get them going.
So with that, Wayne, I think we should wrap it up.
Okay.
Yeah.
Been a great session.
Yeah, for sure.
Yeah.
If you guys have any questions on any of the topics that we covered,
Yeah.
our information is going to be below.
Yeah.
Thanks again for joining. And if you haven't subscribed, we would love it if you click that subscribe button. Really helps out the content.
Yep.
Get it out there.
And if you would like to get this monthly, basically, stats of what's going on, a newsletter, we'll keep you informed on what's going on in the real estate market.
Yep.
If you have any questions, just reach out to us in any way possible. That's going to be listed below, and we'll be there for you.